Every time the Federal Reserve makes an announcement, currency markets move, sometimes sharply. Traders around the world stop what they are doing and watch. If you want to trade Forex seriously, understanding why that happens is not optional, it is foundational. The Federal Reserve, usually called the Fed, is the central bank of the United States. It was created by Congress and signed into law in December 1913 after a series of banking panics destabilized the American economy. Its job at the most basic level is to keep the financial system stable. The Fed is made up of three main parts. The Board of Governors sits in Washington, D.C. 12 regional Federal Reserve banks are spread across the country. And then there is the Federal Open Market Committee, the FOMC, which is the group that actually votes on interest rate policy. The Fed operates independently, meaning it makes its own decisions without needing sign-off from the White House or Congress. That independence is intentional. It keeps monetary policy insulated from short-term political pressure. The Fed has two core goals, known as the dual mandate: maximum employment and stable prices. Those two goals can pull in opposite directions, which is why every Fed decision involves a genuine balancing act. The most powerful tool the Fed holds is the federal funds rate, the rate at which banks lend money to each other overnight. When the Fed raises that rate, borrowing gets more expensive across the entire economy. Spending slows, inflation cools. When it cuts the rate, borrowing gets cheaper, spending picks up, and growth is encouraged. Simple in theory, complicated in practice. For Forex traders, the Fed matters because the US dollar is involved in the vast majority of currency transactions worldwide. When the Fed raises rates, the dollar tends to strengthen. Higher rates attract foreign investors seeking better returns on dollar assets. When rates fall, the dollar can weaken as investors look elsewhere. That connection between rate decisions and currency values is one of the most important relationships in Forex. The Fed communicates through several scheduled channels: FOMC meetings 8 times a year, press conferences from the Fed chair, detailed meeting minutes released 3 weeks later, quarterly economic projections, including the dot plot, and regular speeches from Fed officials. Each of these can move markets. Experienced traders keep a calendar of these events and prepare in advance. That preparation is the practical takeaway here. Before any major Fed event, review recent inflation data, employment figures, and GDP numbers. Understand what the market is already expecting. If a rate hike is fully priced in, the actual announcement may barely move the dollar, but a surprise in tone or language can cause a significant shift. Know the context before the event, not after.